Welcome, everyone, and thank you for taking the time to join Cobalt Blue Holdings Investor Webinar. Today, you've got me as your host. I'm Joel Crane, the Investor Relations and Commercial Manager. I'm joined by our CEO, Joe Katarevic, and the Executive Manager, Andrew Tong. They're both fresh back from Japan, where they're meeting partners and potential customers, and off next week to DC. So it's good that we're able to catch them in between, very relevant times, obviously. The intention of today's webinar is to discuss three things. First of all, to update on the Broken Hill Cobalt project, the recently signed heads of agreement with Iwatani, as well as the strategic review that we announced last week. Also, to give an update on the Cobalt Nickel Refinery project and the progress there, recent test work and discussions with potential customers. And we're also going to provide a Cobalt market update, which we do think is towards the bottom of the cycle. So interesting times indeed. Just in terms of housekeeping, this call is around 30 minutes being allocated. All participants are on mute. And if you'd like to submit a question, please do so in the Q&A box. Type your question, just click send. I'll moderate those questions and do our best to answer and group as many together as possible. But in the interest of time, we may not get to all of them, and we'll do our best to answer with follow-ups. And just as a reminder, this webinar is recorded, and a copy of the recording will be uploaded to the website and the socials as well. So with that, I'll hand over to you, Joe.
Yeah, thank you, Joel. Good morning, all. I'm Joe Katarevic, the CEO of Cobalt Blue. Good day, all. And we have a short presentation to walk through, and then we've allowed time for Q&A, particularly with the recent announcement in mind. Just by way of background, we've recently announced a partnership with Iwatani Corporation. Last year, they came on board as a partner for the Cobalt Nickel Refinery, which will be based in Kwinana. That's in its final phases of pre-construction development. And more recently, we announced a partnership with Iwatani Corporation for the Broken Hill Cobalt project. I'm told by the lawyers I need full disclosure, which includes the fact that that relationship is non-binding and is subject to hurdles going forward. But it is a strong relationship, and I can speak on behalf of Cobalt Blue. It is a strong and developing relationship. And as Joel has just mentioned, we've just come back from Japan marketing with Iwatani, and I'm very, very positive about where that relationship can take us, particularly with a view to connectivity into Japan and ultimately into the allied market chain, particularly the US. The last point I'll make on Iwatani's relationship with us with respect to the Broken Hill Cobalt project is they've signed as a partner without knowing the exact scale and form of the project, because that's obviously subject to review. What that should tell you is that they see strategic value in that project, irrespective of the finer details of its final form. And that should tell you something about the strategic scarcity of a project like Broken Hill going forward. Thank you, Joel. In terms of the project itself, this slide talks to where we've come from. We have considerable Q&A on where we'll go to, but just to establish a baseline, we're a primary cobalt project making largely a cobalt-centric product with some nickel as well. The only major byproduct outside of those two metals is elemental sulfur. For those familiar with the story, sulfur is a precursor for particularly the fertilizer industry in Australia. So it's a very nice segue into supporting Australia beyond just the metal value. The resource is stated there. There is a compliance table at the back with a full mineral resource statement, but is a considerable scale of resource, and we're looking to commercialize that into production. Importantly, the work that we've done in the years to date, both in ground but also processing and lots of work in that technical competency area, has created a strategic library, a library of technical studies, which we'll now piggyback on when we're focusing on a higher margin and condensed product. By way of background to those new to the story, outside of the open cut mine, the processing is through a concentration step where we make a pyrite-rich concentrate. We then thermally decompose that product in a kiln step, and then look to leach that into a mixed hydroxide or an intermediate. The concept logistically then is to take that mixed hydroxide, rail it to Kwinana, where the refinery will be located, and ultimately make a battery-grade cobalt sulfate. So that's a little bit of background. We'll look forward to informing you on the way forward.
Good morning. My name is Andrew. If I haven't met you, it's great to be on this presentation today. I'm just going to talk you through our plans for the cobalt nickel refinery. We've got a photo here showing the current Iwatani site in Rockingham, Kwinana district, which is just south of Perth. At that site, they currently make some fused zirconia products or chemical products, and there's a piece of land between the buildings that we want to build our refinery on. So we identified this last year, and as Joe said, we've progressed through to non-binding agreements with Iwatani and looking forward to moving those to binding agreements in due course. This year, we've been really focused on 4 or 5 aspects of advancing this refinery. So one of those is working through the feed and offtake contracts. One of those is working through the project finance. We've been doing the detailed engineering design. We've been looking at the permits. For this particular site, the permitting aspect is really a modification of the existing works approvals, and then there'll be some additional permits for the buildings. So working with West Australian Government on those. And then the final piece that we've been working through is our test work program, which I'll touch on in a moment in a further slide. But just as a quick summary, our refinery is targeting 3,000 tonne cobalt and 1,000 tonne nickel in the first phase of the project. That can then be expanded when the Broken Hill project gets online. We'd be looking to add a further 3,000 tonne of cobalt or thereabouts and increase in the nickel supply. So that expansion case still exists for us as an upside, but at the moment we're really focused on this initial build out at the 3,000 tonne cobalt, 1,000 tonne nickel. In terms of the economics, we published these to the market in November last year. We're really targeting an annual EBITDA of $30 to $40 million in that range, obviously dependent a little bit on the cobalt price. And that's the numbers here are reported on a total basis rather than split on a JV shared basis. We're working through all these aspects of the project with a view that by around Q3 this year, we'll be able to have a clear path then to moving ahead with financing and construction thereafter. But we'll look at the slide in a couple of minutes with the timeline. Joel, could we just flick to the next slide, please? One of the main things of activity that we've been doing, as for those who have been shareholders for a while, we've got a pilot demonstration plant at Broken Hill. We've been running that successfully since 2021, focused on the Broken Hill material going through that. Late last year, we were able to purchase some feedstocks for our refinery business. So these are cobalt nickel intermediates that are available on the global markets. So we purchased these and we've been processing those through the plant. We've produced our first cobalt sulfate product from that third-party feedstock. And you can see there a little photo of the solvent extraction circuit that we've been running there with the cobalt being separated from the nickel. Last week, Joe and I spent time in Japan with our colleagues from Iwatani talking directly with the PCAM manufacturers over there. And in terms of the battery supply chain, you've got the mines processing the ore, then you've got the refineries producing the high-grade battery raw materials. Those raw materials then go into the precursor market if you're on the cathode side. So that's cobalt, nickel, manganese, and they make the precursor. Then the precursor is mixed with lithium to make the CAM, and then from there it then turns into the cathode side of the business. So it's really important for us when we're talking about our refinery, not just focusing on the supply side, but making sure that the product specifications meet the requirements of the PCAM market, and then ultimately they move into that whole battery side and then to the OEMs. One interesting aspect of the battery supply chain is where do the guarantees and warranties begin on battery performance? They actually begin with the PCAM. And so making sure that our feed raw material into that PCAM is on specification then enables the PCAM guys to be able to provide those warranties on battery performance. So it's a really interesting dynamic to work closely with those groups and ensure that our product meets their specifications. Those specs are not just the metal concentrations, but they also come in for particle size, for handling, for flowability. All of those aspects are very important. And so part of our work is not just a chemical specification, but then working through the handling of that, the logistics of that, the storage of that product, and ensuring that ultimately when it's used in the pecan manufacture, it meets all of their requirements. In terms of our overall timeline, this is going back to late last year. We published our study, and then this year it's really focused on bringing all of those aspects up to a level required for construction, and we're aiming to commence that later this year. Then there's roughly a 12-month build through 25, and then that gets us to the point where we can commence the commercial scale validation. And this really is a huge point of discussion, as I touched on before with the pecan makers. They need to validate the commercial scale facility. Yes, we've already passed through the initial validation of our flow sheet and the product and our operating parameters through our demonstration plant. So they've already given us a tick in terms of meeting those specs. But now it's how do you do that on a commercial scale? So really the focus is on the scale up of our processes, the scale up of our parameters, the scale up of the equipment, and so on and so on. And so there's a strong feedback loop that we're working through at the moment with these pecan manufacturers. Now that they've had a look at the spec, they've said, okay, can you please tweak these aspects of it? How are you going to do that at a commercial scale? So while we've put up a timeline here through to building the plant, then there's a validation timeline, which we're working through with the manufacturers, which covers the bridge between construction, validation, and then commercial operations thereafter. And so we're just teasing through what does that mean for the various offtake agreements and the collaboration opportunities that we have. Thanks, Joel.
Thanks, Andrew. We'll move into Q&A in just a moment. Before that, I thought I'd just give a quick update on what's happening in the cobalt market. Obviously, followers of this company and broader markets in general know that prices have fallen really quite substantially in cobalt, as well as other battery materials, namely lithium and nickel. And now cobalt is the lowest it's been since the COVID era, just below $14 per pound. And this is really due to an oversupply of in the global market, not necessarily a demand issue, but just too much supply coming out. And that's following a decade of low interest rates, massive capacity build-outs, and those were really to capture the strength in both the copper and nickel markets, because as we all know, cobalt is a byproduct of those. So it's really been sort of an unfortunate bystander in a period when copper and nickel have been quite strong. But I thought today to take just a few minutes to sort of look back into history in the supply and demand balance and the behavior of a cobalt price over these periods to really suggest what it may look like into the future. So when we start our little journey here back in 2012 through 15, this is when cobalt market was much smaller, less focused on the EV or rechargeable battery markets. And there was a period of oversupply, and prices were sort of subdued around the in $20 to $15 level. But as we approached into 2017, you saw a market deficit arise. The market got wind of that, and very quickly prices started to shoot upwards. That undersupply lasted sort of through the first half of 2018, and price still continued to rise to pretty much record levels at that time. A supply surplus did emerge as suppliers responded to that and put more cobalt into the market. And then in 2019, you had a continued oversupply. Prices fell back quite sharply. As 2020 entered, we did see market deficits re-emerge. But unfortunately, as we all know, we entered that period of COVID when demand for everything shifted downwards, and price during that time continued to fall lower. But the market didn't really change throughout that period. Producers kept producing, and demand kept increasing, particularly in the rechargeable battery market. And we ended up seeing quite a substantial deficit in 2021. At that point, prices started to recover and really try to send that signal that cobalt is in strong demand. Throughout 2022, that deficit remained, but then there was a big project pipeline in the DRC that really started to increase You end up seeing a market surplus in 2022, but that really didn't happen towards the end, and prices continued to increase. As 2023 carried on and DRC projects really start rolling out in large scale, you saw market surplus and prices come back quite sharply. Now, as we enter 2024, we're really entering a period of peak oversupply as the DRC projects roll out. But as we go into 2025 and 26, that surplus really starts to wind down. And we just have to remember that this is a period of, as I said at the beginning, vast investments in capacity, particularly in Central Africa, at a time when demand is also quite strong and hasn't really wavered. So as supply growth starts to wind down, demand will stay the same. And then we're going to see a period of extended market deficits. Now, these deficits that are appearing here are unlikely to happen to this scale. But what's really important is to acknowledge that there is a forecast for greater demand growth over supply. And given what we know in the past, when you do have these deficit market situations, you know what price can do. So the suggestion is that we're likely to see price recovery as this surplus rolls off, which is quite fortunate because this is essentially the time that Cobalt Blue is entering the market, as Andrew sort of outlined, around the 2026 period. So it's quite fortuitous in terms of that timing. Okay, we're going to enter the period of questions and answers. We've only got about 10 minutes left. So there's quite a few just around the Broken Hill Cobalt project review. Perhaps, Joe, you can answer the first one. What sort of pricing around the cobalt market is required for this project to continue?
Yeah, thank you. So we're looking ultimately for a project that works, let's say, well under the long-term pricing forecast for cobalt. So historically, the 30-year average is near about $27 US a pound. Looking forward, our consultant, and we use Benchmark Minerals as our global consultant in this space, also forecasting broadly a long-term price of $27. And so we're looking for a project that works well under that so that we can bring into the market should markets not recover to the degree that potentially the supply-demand chart that and the forecast that Joel spoke about come in. So we're after a smaller, nimbler project, lower capex, and the lower capex is important for us because we're a small company and ultimately the capital has to be funded. So a smaller capex and ultimately a quicker to market offering. So it gives us a strategic option rather than create or sit behind this major project that we've worked on, a project that frankly in today's market of $13 and $14 cobalt would struggle to get financed. So it's a strategic option to build on top of the extensive library of work that we've already done. Thanks, Joel.
Thank you, Joe. While we have you, can you just comment a little bit more on sort of the current situation with the DFS on the Broken Hill Cobalt project? Why are we continuing with this current strategy?
Yeah, actually, if you don't mind, I might hand that to Andrew. Thank you.
Sure. Thanks, Joel. Thanks for the question. In terms of our DFS, as we go through the engineering studies, you need to set the scope of work. And so when we embarked on our DFS, we set a scope of work, the battery limits or the project definition, and we commenced that with SRK, GHD, and with Worley. Now, obviously, as you go through that process and different information becomes available, you're free to change the scope of work, but that then entails a significant body of engineering rework. So a simple example might be as SRK progressed their mine development, they selected a particular mining fleet size that has roll-on effects to then the maintenance shed, the size of the roads, the ramp widths, and so on and so on. So if you change that scope at some point, there's a significant body of rework to be done. So over the last couple of months, as we've been looking at this DFS and we've been looking at the information that's now come to hand out of that, we've taken the view that rather than just push on and complete that project definition in a sense, we want to go back and redefine the throughput, redefine some of the assumptions that were built into that, and then take it in a slightly different direction. So some of those assumptions, as I touched on there, could be the mining fleet size. It could be things like the methodology around crushing that we had selected. The throughput obviously affects some of those equipment items. It could be things like the water consumption and the availability of that, or it could be power consumption. All of those assumptions at the start of the project give you the project definition, and they lead you into particular sets of options that you can choose. So let's just, out of those ones that I gave you, I just wanted to give you a bit of color on the power side. In terms of our overall throughput, we had defined, and this comes from our earlier study work, a power demand of around 70 to 80 megawatts flat load power demand. That then sets in course a set of engineering studies around how to deliver that to site and how would you integrate with the grid. And so you start to go down that thinking. If we change the size of the project, and for example, if we cut the project by half in terms of the power demand, then it opens up different opportunities for supplying that power to the site. That's a simple one. There's many examples of that through the course of the project. So what we need to do is sit back, look at all the information. We've now got some really good definition on that, costings, and so it helps us to do an option study and look at the different scenarios, redefine the project, and then set that off on a slightly different feasibility study.
Thanks, Andrew. Maybe moving on to some more details around the refinery. There's a few questions just around the timeline, but really, I think to summarize them all, what do you think is the largest hurdle in getting the refinery to production? What are the challenges, and what does it look like to get that first production out?
Sure. So I want to address this with a couple of comments. The first comment is that as we're now really pushing hard to get the refinery up and running, go through finance and construction and so on, what's becoming very clear to us is that in this particular space, it's a chemical refinery, it's not a mining project. And so we have to be really clear about what we define as pre-development, in development, in operation, and so on. The words that we really want to be focusing on is that there's a construction period, which ultimately is to hand over from, say, the EPC, EPCM contractor to the owner. So there's a construction completion sign over. Then there's a validation period. In that validation period, we will be running the plant at a particular capacity. It could be nameplate capacity or 70% or 50%. That strategy is still to be defined, but that plant will be running. So in that validation, we don't want to use the same term as commercial production, because ultimately the validation with the PCAM maker is the definition of when you're moving from a validation phase to a commercial production phase, where it's just purely then day in, day out running it to those requirements. And so really we think of our refinery rollout as going through a construction phase, practical completion, then it's a validation phase, which typically would cover all the commissioning, bringing it up to nameplate and so on, getting the product validated, then you turn into commercial production. So really, that's my first point, is defining that for our chemical manufacturing plant, construction, validation, commercial operations. In terms of coming specifically to your question, we want to be in that production phase, the plant operating really from end of 25, early 26, but it really comes down to how is a PCAM manufacturer going to validate that material can then go fully into the supply chain all the way through to battery manufacturing.
Thank you. Very clear. Question probably for you, Joe. Can you just sort of run us through of how you expect the refinery to be funded?
Just to remind investors, we on the 27th of November of last year, we put out an ASX, quite a complete ASX announcement with respect to the refinery and with respect to the building blocks and of course the economics. As a reminder, we published a 47 million Australian for a 100% basis, pre-production capex, a contingency of 7 to 9. So that gives you sort of $55 to $60 million range in terms of that capital, and there was some costs as well pre-construction in terms of some of the engineering work that Andrew touched on. On top of that, then there's working capital, obviously, to operate. The funding is like any capital raise; it works on a cornerstone. At the moment, we are heavily engaged, and I use that word intentionally. We're heavily engaged, firstly with WA government, but secondly with our own Commonwealth government with respect to putting a cornerstone in place. That cornerstone will do two things. One is it'll kick off that capital raise, but more importantly, governments create certainty and confidence around projects. So if we can bring in some of that government money up front, it then creates what we call a crowding situation. It crowds in attractiveness from other commercial sources. So we're looking at state, we're looking at federal government. Andrew and I are in Washington on Monday and Tuesday to have discussions with US government. They are very interested in creating production chains which include Australian source material, Australian processing material, all the way to US EV and US markets. So there's a third government that can help us with assistance. On top of that, we are dealing with vehicle OEMs in terms of their ability to look at prepayments and other sources of funding. And then we're also looking at strategic investors with respect to putting in some money at the refinery or at the headco level to create that outcome. I would add that our project partner, Iwatani, being Japanese, has recourse to its own funding for its share, and that recourse includes Japanese government, which has some very large funds set aside for creating these production chains through Japan. So really, it's about cornerstones, it's then about strategics, and then ultimately, whatever residual is left, we may come to the market, but really the ideal is to try and crowd as much of that funding into those first two categories. Thank you.
Thank you. Now, we're rapidly running out of time, but I'm hoping to get in two more questions. One on Cobalt market, which I'll touch on in the final question, just sort of on the relationship between the refinery and the Broken Hill Cobalt project. We do have a number of questions on the Cobalt market. Are we concerned about Cobalt being thrifted out, not being used in a sort of technology? We get this a lot. I'm sure this is in a lot of people's mind, but I'll just address it with sort of two responses. First of all, high pricing is sort of the enemy of Cobalt in the sense that when nickel and cobalt prices were extraordinarily high a couple of years ago, that's when battery makers started looking for alternatives. Now that it's sort of back down to a lower level, it is much more accepted that the cobalt nickel based technologies for battery cathodes are the more superior in terms of longer term and range. And so you sort of move away from that, thrifting away from it. Secondly, there is a large amount of buy-in or dedication from the battery maker community. I just point to a deal from about a month ago between GM and LGES of setting up 10 years worth of gigafactory capacity at a price of around $20 billion US. So, and that's for nickel cobalt based cathodes. So there hasn't been a move away from a large move away from it. There was a diversification as cobalt prices are high to sort of non-cobalt nickel bearing batteries. But that stopped quite a few years ago after the price started to come off. Finally, just to wrap it up, can we just talk about a little more about this sort of what is now the relationship between the Broken Hill Cobalt project and the cobalt nickel refinery just south of Perth?
Sure, Joel. I'll make a couple of comments, and then perhaps Joe or yourself would like to add a couple more. In terms of our overall timetable, I think we've been pretty clear today and over a number of announcements that the refinery is our short-term, nearer-term project opportunity. We really want to get that built out, and there's a couple of reasons for that. The number one reason is that puts us into the market as a producer of this high purity product. Once that's achieved, then it actually makes the mine much easier to see the strategic play because you've already got that whole customer end chain already built out and operating. Then the mine can focus on essentially just being a supplier to the refinery. But that sort of discussion and strategic approach has really come out of this whole uncertainty around the supply chains and feeding raw material and traceability from one side all the way through the chain. So in other words, the supply chain is saying we really got to focus on Australian product and so on. So let's build out this refinery, get that going, get that into the market, get that traceability happening, and then a mine can come on much more easily knowing that all of that downstream is there ready to go. In terms of the work that we're looking at for the Broken Hill, it's been touched on a little bit earlier today, but we're looking to really come up with a 10-year plus project there, focusing at around about 2,000 tonne cobalt. If we can have something like that, then it's a meaningful supplier, and we think that that will significantly improve the margins of the business. But obviously those targets are still subject to further review. But those are the sorts of things that we're looking at for the Broken Hill project.
Well, we've run out of time. Thank you, everyone, for joining us. We'll continue to update the market as we evolve through these projects and exciting times for us. And especially a big thank you to shareholders and those who are sticking through us through these times. We'll do our best to keep the business rolling as successful as possible. With that, we'll say goodbye and thank you very much.